the main journey through financial statement analysis. That said, there is a big pre-read section, I think 9 modules in there, which covers a lot of fundamental knowledge that you need to get through FSA. So if you haven't seen financial statement analysis before, and you haven't seen any of the pre-read, strongly recommend that you go back there. It is not, quote, directly examinable, but it is key to help you through the rest of these modules. My advice, if you start these modules, you start to come across terms that you don't understand, you haven't seen before, it is a red flag that you need to go back to the pre-reads. That said, we're starting here with learning module 1, Introduction to Financial Statement Analysis. Nothing in here is too heavy. It's 26 pages in the PDF and a mere 5 learning outcome statements. So you might find you're okay here, but as you get into the other learning modules, as I say, if it's looking unfamiliar, get back to the pre-reads. There is a lot in there. Now, that's out of the way. Let's get into this Introduction to Financial Statement Analysis. That is LM1. Just the 5 LOSs. As I say, the first one is describe. You're going to find this entire 26-page reading is describe. LOSA is describe the steps in the financial statement analysis framework. And here they are. There are 6 of them. So imagine you go through your CFA program, you come out as a freshly minted CFA charter holder, and you are looking to do some analysis. How do you do it? Well, you go all the way back to the start of FSA, learning module 1, and you follow these steps. Number 1, ask yourself, why are you doing this? Determine the purpose and the context of the analysis. What question are you trying to answer? What conclusion are you trying to get to? Maybe you're just trying to decide whether to buy it for your own portfolio. Maybe you have responsibilities for somebody else's money. You're putting it in their portfolio. Maybe you're trying to see if it's a good credit. Maybe you're trying to assign a credit rating, and so on and so forth. But it's important to determine that before you start, so you know the context of the analysis, and you can do the rest of these steps sensibly. For example, number 2, once you've decided what you're doing and why, then you collect the data. What you're doing will, to a certain extent, drive the kind of data that you collect, and certainly will drive the bits of data that you focus on within those sources. So you may have a look at the financial statements. I imagine you would if it's an equity, balance sheet, income statement, cash flow statement, and so on. If the terms balance sheet, income statement, cash flow statement don't make sense to you, that's strike 1 in terms of the pre-reads. You need to go back and look at the pre-reads. But let's say we are looking for credit worthiness. You're going to dive perhaps more into the cash flow statement and the liability section of the balance sheet. If you're looking as an investment, maybe you're looking more at profitability measures. Discussions with management. Certainly if you're an analyst covering an equity and you're putting out a research report, you would expect to have a call with management, maybe even a company site visit. So you collect the data, and then step 3, you process that data. You'll calculate ratios. Again, your context will dictate which ratios you're going to calculate. Keep going with my example. If it's to come up with credit worthiness, you're going to focus on cash flows versus debt outstanding, interest coverage. Growth rates. If you're looking for perhaps a growth portfolio, seeing if this fits into it, you're going to calculate a growth rate based on historic rates, trying to predict the future. Common size statements. Again, good flag that you need to look at the pre-reads if common size statements don't make sense to you. That's taking away the difference in size between entities and calculating ratios that are more comparable. And you'll use a whole host of statistical tools. We'll get into that a lot more in quant. You maybe do some regression analysis. So you'll process your data. You'll come up with perhaps a spreadsheet of data, an Excel sheet. You'll do some regression analysis on that sheet. You'll have a set of results. Step number 4, you'll analyze and interpret those results. And come up with, once again, depending on the context, conclusions, recommendations. What is its credit worthiness? Should you make a loan to this business? Should I include it in my portfolio? Then step 5, develop and communicate your conclusions. Perhaps in an analyst report. And we always like to link the curriculum together where we can. Note, there are specific rules covered in the ethics section on what you should and should not do in an analyst report. So for example, fact versus opinion. You might get carried away. You might calculate these growth rates and these ratios and decide they look spectacular and that this company is a real winner. And you might write in your report, this company will double sales within the next year. It will deliver 10% growth. No, you have violated the standards of practice. You cannot state those things as fact. What we're doing, and we'll see a little bit of this in the next LOS, we are looking at historic information to try and make predictions, forecasts about the future. Those forecasts are your opinions. They cannot be stated as facts. So you've got to be careful, and you've got to make sure you follow up, particularly again if it's an analyst report. If you have put out there, and you can put out an opinion that says buy, hold, sell, that's your opinion. You can't say it will go up in value, but you can say I anticipate, I would expect 20% growth, hence I recommend a buy. But that's right now. As you roll forward and events happen, life happens, the markets happen, and macro variables change, you must keep on top of this recommendation. In case your client happens to pick up this report again, open it on the website, see the buy in 8 months' time, think, oh, it's a buy, and buy it. By which time, this company may have completely collapsed. So you must follow up, make sure all of your assumptions, all your predictions, you still stand by. They are still relevant. On to B. We have described the roles of financial statement analysis. Not much to this one. And it's broken down pretty well on this slide, even if I do say so myself. Describe the roles. Well, the roles to evaluate performance and position. Once again, we can tie that to some fundamental pre-read information on financial statement analysis. Performance, income statement, position, balance sheet. So evaluate where we're at, the position the balance sheet will show you. What's your liquidity? What's your solvency? Are you well positioned for the future? Do you have flexibility to take advantage of opportunities? From the income statement, your performance. Are we delivering growth? Are we delivering profits? What are you going to look at to try and find out all of that? Well, obviously, financial statements are crucial. You will look at past performance. Maybe you'll go back and look at 5 years history to try and get an average growth rate. You look at where we are right now. What did we deliver last year? What does the balance sheet look like today? All with the aim of offering an opinion, as we said in the last LOS, of what's going to happen in the future. Can we use the past and the current information that we've got to form an opinion about the future? We know the past is not prologue. We know it might change, but we do our best to make an informed forecast. Why? Because we want to make economic decisions. Reading gives us 3 investment decisions, credit decisions, and other. So, as I mentioned in the last LOS, you might be looking to put this investment into your portfolio. It might be an equity. You might be making a recommendation, coming up with a valuation. You might be looking at venture capital, private equity firms making an investment in the entire firm. Could be from a credit point of view, deciding on whether you're going to extend credit. You might be coming up with a debt rating, as we said, or a host of other reasons. You might not be an analyst. This financial statement analysis might be happening internally. It might be management looking at operating decisions, in which case they've probably got management accounts. I say probably. They better have management accounts, much more detailed information than we'd have as an external analyst. But that's it. That's the role of financial statement analysis. Use this information to make economic decisions across a range of different disciplines. Now, not a thrill ride of an LOS, not much in it. So let's just pick up a little example and just kind of give it a little bit of context. We have here, panel A on the left, an excerpt from Sea Limited's, that's SE earnings release. Why we're looking at this? Well, I think it's quite a neat little point the readings make just to make this jump to life in front of your eyes. Let's have a look. Second quarter 2022 highlights. Total GAAP revenue. Again, a little flag that you need to go and look at the pre-reads if you don't know what GAAP is. 2.9 billion, up 29% year on year. And the point really this little extract is making, is that good? Are we pleased with that or not? Total gross profit, 1.1 billion, up 17.1% year on year. Again, is that good? Total net income, or loss, as it turns out, loss, $931.2 million compared to $433 for the second quarter of 2021. Total net loss excluding share-based compensation, impairment of goodwill, $569, and so on. We've got adjusted EBITDA, again, a term you'll see in the pre-reads. Now, the e-commerce segment. Right, we'll talk segmental information shortly. GAAP revenue, $1.7 billion, up 51.4%. Nice. Based on current assumptions, GAAP revenue and so on, total orders. Okay, gross margin for e-commerce improved quarter on quarter, faster growth, transaction-based, etc. Okay. A lot of information there. Do we like it? And to make sense of it and decide whether we like it, let's move to panel B and look at how it was reported. What do we say? Singapore-based Sea Limited reported second quarter results early Tuesday that missed on revenue. And that's really just the point we're making in this little reading, or this little example, I should say. It missed on revenue. The news is reporting this in relation to analyst expectations. It missed on revenue, but it beat on earnings. What did the market think of that missed on revenue and beat on earnings? Well, we can see what happened. The stock plunged 14.3%. But, and this is a little bit of an aside, this last little bit down here, e-commerce full year guidance. In our efforts to adapt to increasing macro uncertainties, proactively shifting our strategies to further focus on efficiency and optimization. Okay, given this strategic shift, we will be suspending e-commerce GAAP revenue guidance. So information we put out to help analysts to tell you what we expect is going to happen in the future will cease. The market did not take that well. In fact, shares plunged, as we see, 14.3%. So, a little bit of an out-of-date example. It's back in 2022. And I would encourage you to go and Google. I don't want to spoil the surprise for you, but go and see if SE on the New York Stock Exchange is indeed still trading, if its shares did indeed recover from this knock. But the point is, we are reporting the news in relation to analyst expectations. So that's one big use of financial statement analysis. Okay, let's move on. Next up is LOSC. It's describe again. They're all describe. Describe the importance of regulatory filings, financial statement notes and supplementary information, management commentary, and audit report. So we're just going to have to hit each of these in turn. In terms of the exam, let's not get bogged down in spending valuable financial statement analysis time learning, names of forms and, what percentage of the world are members of IOSCO. It's 95% of the capital markets. But things like that, it's not really analysis, is it? That's not what we're trying to focus on. If you think of the LOS, describe the importance of. We want to know why these things are important. So that's what we need to take away. Let's have a look. First of all, regulatory filings. It makes sense to go back and say, who is regulating? It's not just Warren G. It's organizations like IOSCO, the International Organization of Securities Commissions. I've been a little bit lazy not writing that down. But again, it's not the kind of exam that's going to ask you, what does IOSCO stand for? But the name does help you understand what they're doing. International Organization, as I say, it covers over 95% of capital markets, which obviously gives us a little bit of consistency, harmonization. IOSCO has 3 primary objectives: to protect investors, to ensure that markets are fair, efficient, and transparent, and to reduce systemic risk. I would presume if you're going through the CFA Level 1 program at the minute, you were alive and sentient back in 2008, so you know all about systemic risk. Principles. How does it achieve these 3 main objectives? Well, there's a whole host of different principles, 10 categories to look at: regulators, auditing, issuers, and so on. All this reading has done is pick out for us 2 principles, specifically from the issuers category, that relate directly to what we're talking about: financial statement analysis and hence financial reporting. What are they? Well, first of all, number 1, FAT disclosure. By FAT disclosure, we mean full, accurate, and timely disclosure of what? Risks, results, and other material information. Material meaning anything that a reasonable investor would want to be aware of. And secondly, that we should be using accounting standards that are high quality and internationally accepted. Internationally accepted is going to mean either IFRS or US GAAP. For us, for the most part, again, if they're unfamiliar to you, that might be strike 3, you're out, get back to the pre-reads. You should know all about IFRS and US GAAP. Now, that's IOSCO. Let's for a minute get more US specific. US Securities and Exchange Commission, the SEC. What's the SEC got to say for itself in the US? Well, significant statutes. Back in 1933, the Securities Act was passed basically to give fundamental rules on the information that issuers must give and the registration process they must go through. Securities Exchange Act in 1934 recognized that this SEC thing was probably a good idea and gave them a lot more power. And 2002, Sarbanes-Oxley Act focuses hugely on the audit process, the auditors themselves, and a company's internal controls. 2002, a little bit further back than 2008. This was a follow-on from the Enron scandal, which may be before some of your time. So it's worth just Googling, asking GPT about that. Massive failure of internal controls. So SOX, Sarbanes-Oxley, addressed that. Again, for the exam, we're not focusing on dates here. They're not going to ask you what the dates of these were. It's all about, remember, describe the importance. Why are they important? Well, if we can make sure our auditors are independent, our internal controls are strong, it gives us, as users of the accounts, more confidence that they are fairly stated. Filings, whole host of filings. They're required by the SEC if you are registered as an issuer in the US. So are you going to get tested on the names? I doubt it. But just know there is an initial registration statement, and then there is regular reporting. So we've got the 10K, the 20F, the 40F annual reports that companies are required to make. We've got the annual report. That's what we're going to focus on most going through this curriculum. Proxy statements, interesting. Form DEF, DEF 14A. Shareholders must receive a proxy statement before shareholder meetings. It's just making sure they have a voice, they know what's going on, and they have the ability to vote. Shareholder meetings are held at least once a year, and that proxy will be sent out telling shareholders any proposals that are up for a vote. It'll give information about who owns securities, what management, how much management owns rather, the principals and so on. So as an analyst, you can get a lot of useful information out of those proxy statements. You also have quarterly reporting. So the 10Q comes out on a quarterly basis. For many non-US companies, 6K. So not only do we get the annual report, we don't have to sit around waiting for that. We can look at the quarterly reports. And it goes on. We've got Form 8K. We're going to pick up from an 8K on any material events that might happen between these quarterly reports. It might be in the 6K, to be fair, for non-US companies, but between those dates, you make a big acquisition, a big disposal, you'll be able to pick it up in the 8K. Forms 345 and 144. That's going to cover beneficial ownership. That's going to tell you ownership by directors, officers of a registered company, and anyone with more than 10%. So you can see if people are building up their holdings. That's going to give you information potentially going forward about any kind of takeover bids. And the 11K. Annual report on employee stock purchase savings and similar sorts of plans for your employee compensation. That'll give you vital information about not only shares that are an issue, but shares that are to be issued, which will have a big impact potentially on your diluted EPS. So it's really knowing the importance again, rather than the names of each form, but the fact that there are a whole host other than balance sheet, income statement, cash flow, a whole host of different filings that can give you useful information. And over to the European Union. Finally, we talked IOSCO globally. We talked the US, European Union. Kind of two levels. Member states regulate their own capital markets, but there's some EU-level regulation. Notably, the consolidated accounts of EU-listed companies must use IFRS. Again, should be familiar with that, as I keep saying. Securities regulation they've issued, the ESC and the ESMA. So again, just something to be aware of. Don't really need to go into any detail on what they're doing. On to financial statement notes and supplementary schedules. We're going to focus heavily throughout this entire FSA journey on the financial statements, the primary statements, balance sheet, cash flow, income statement, etc., and the financial statement notes, otherwise known as the footnotes, which are and can be extensive. You might get 15 pages of primary statements at most and 150 plus of footnotes. So they are additional information on, I say every, maybe not absolutely every single one, but pretty much every line of the balance sheet and the income statement. Plus a whole host. As it says here, etc., this is not an exhaustive list. These are ones that I think kind of jump out as being important. You'll get a note, a footnote on the major accounting policies. That's huge for comparability. As we go through this journey of financial statement analysis, we're going to see a lot of accounting choices that companies have choices to make on how they represent numbers in their accounts or how they calculate numbers in their accounts. Two exact identical companies with exactly identical transactions can end up with a different profit for the year because they have a choice of how to account for things. Subsequent events. This is huge, potentially. And just go back to the importance of regulatory filings. We might be able to pick them up in that 8K. But within your accounts, if you've got a, let's say, December the 31st year end, it's unlikely those accounts are going to get audited and published before March, April. So subsequent events will tell you things that happened between the cutoff date, the end of the financial year, and the date the auditor signed the accounts. Now, there may be huge uncertainties that happen that throw the company's existence into doubt. Contractual obligations. Maybe you have signed a contract which obligates you to bail out another company that you're not even related to on the face of it. Off-balance sheet items. We'll talk a bit about this when we get to the liability section. Off-balance sheet items. It might be a liability that's not there on the balance sheet. At least not obviously there on the balance sheet. And there's, as I say, dozens and dozens and dozens more. So don't be fooled in the exam to saying, what does an analyst need to look at in the annual report? Oh, just the primary statements. There's a huge amount of information in here, which is vital. And I said earlier, we'd have a little look at segmental reporting. If you've got a multinational company, a conglomerate across a whole range of different businesses, splitting out its results by business and geographic segment could be vitally important. You know, I say to you, look, I made 900 million this year. Okay, great. What did you make it from? I made 850 from selling office furniture to the US government on a 10-year guaranteed contract. And I made 50 billion exporting high-tech weaponry to a politically unstable country. Okay, I like the fact that 850 million out of the 900 was office furniture. Switch that around, and obviously you've got a completely different risk assessment of this company. Same with the geography. So it is required for businesses with different segments to report by operating segment. An operating segment, as we defined here, generates revenue and expenses. Might not yet have expenses if it's just started, but it generates revenue. We're not just talking about a little cost center here. Its results are reviewed regularly by senior management, and it has discrete data. You have to be able to box off revenue and results, revenue and expenses rather, from this segment as opposed to this one. Otherwise, you can't do any sensible analysis. How do you decide what's big enough? Well, if it makes up at least, so 10% or more of revenue, assets, or profit or losses, then it must be disclosed as a segment, and all reported segments must add up to 75% of your external revenue. If they don't, then you need to go back, ignore this rule, and say, I'm going to find more segments until I've reported segments that cover at least that 75%. Why? Again, remember, it's all about describe here. Well, so I can make a sensible assessment of the risk of this company overall. different segments have different risks, different geographic areas, different risks. It's not perfect. Your customers might be in one geographic region while your business is in another, but it helps. Again, just a quick diversion. It's again SE. What segments do we have? Consolidated is the total. So add across all of our segments. We'll get to our consolidated. We've got digital entertainment, e-commerce, digital financial, other, and unallocated. Remember earlier on, he said, we're going to stop giving full year guidance for the e-commerce sector. Well, of revenue of 9.9, e-commerce is 5.1.